Hello, my name is Jonathan Burgess. Welcome to the Big Money Management YouTube channel. Today, I have a very special guest and partner of ours at Big Money Management, Michael Rothman from Succession Capital Alliance. He's coming live with me today to talk about exiting your business, different ways that you can do that. And Michael has helped, I think $3 or $4 billion worth of businesses exit successfully. And we've definitely got a unique way to do it. So we work with a lot of business owners here at Big Money Management. So, in the next 20 minutes, you're probably going to learn something about a way to exit your business that you've never heard of. So I'm super excited to have you here, Michael. Thank you for coming on. And yeah, you guys, your track record speaks for itself. I mean, Succession Capital, you guys have been around since 1996, over $5 billion in funding methods, of which we're going to talk about in a minute. So yeah, super happy to have you here.
Thanks for having me.
You are a CFP. You got the letters behind your name. You've been doing this for a while, but really want to hit today for the viewers on exiting your business. Why it's so important to have an exit strategy in place. Even if you're not planning on exiting, why having this out in front of you can be so helpful. So I've got a couple different types of exits that I'm going to go through, different scenarios, but tell everyone watching right now a little bit about yourself.
Yeah. So as you know, Jonathan, we work primarily in the high net worth life insurance space. We're known nationally as the #1 firm in using life insurance planning for high net worth individuals. The majority of those high net worth individuals own private businesses. I'd say about 80% of our clients or more do. So we have, as you mentioned, done a little over $5 billion of fundings for life insurance premiums over the last 25 years, and we add about $300 to $400 million a year. We have done about 55 billion of death benefit policies that are in force through our program nationally. And while we are focused on the life insurance piece of this, that is one piece of a very complex planning process around businesses. Exiting a business is not simple. There's not one way to do it. And even in one way that you particularly are going to pick, there's a lot of issues around it. Things like that a lot of business owners don't think about: estate taxes, capital gains taxes. And so there's strategies that our clients employ to deal with capital gains, to deal with estate taxes. And life insurance, which is what our focus on, is a way to mitigate some of those issues and help with some of those issues, specifically around the issue of liquidity, which is a massive issue for businesses that are exiting or that are passing to the next generation, which is a form of exit I'm sure you'll talk about. So with that being said, I think it's important for everyone to know that it's a complex issue. We're going to try to keep some of the simple, important points here today, but you do require a team of professionals, someone like myself and like yourself and attorneys and accountants. But the best thing you can do from a high level is understand some of the dynamics and start to plan for them, because the earlier you do it, the easier it will be once that day comes.
Yeah, that's right. So, if you have never heard of life insurance as an asset class, I think number one that people need to understand that. So I think that the easy, and we'll back into how premium financing works from the exit of the business. So if you've never heard of life insurance as an asset class, essentially what it is, I like to refer to it as a rich man's Roth IRA. Now on the surface, you're putting in premiums, they're growing tax deferred over time, and then you use them to take out tax-free distributions in the future. And it's really something that the IRS cannot touch. Life insurance is a social good. So you might be wondering how this ties in from a business exiting standpoint. And how it does is, if you were going to use one of these on the surface, like for instance, in my business, if I were going to put money into a life insurance policy to make it worth something in the future, I would have to put a ton of cash in up front. So for some people, their standard of living, if they're getting passive income, they want at least 40 or 50 grand a month. And if you've worked hard for your business, you deserve to do that. Well, if you were going to fund a permanent life contract like a rich man's Roth IRA, this may cost 5, 6, 700, even $1 million a year, and you slam that funding over 7 years. So you may end up putting between $3.5 million and $7 million of your own money into something like this to take the benefit from it. Well, where Michael and I are what Michael and I are going to be discussing is how you can, instead of using your own money to put into a permanent life policy in this way, you can actually use the bank to fund premiums for you. So Michael, if you want to give everybody a little context around premium financing, and then we'll step into why this is so beneficial for a business owner, mainly from the liquidity standpoint, because they need money to run their business every day. So
yeah. So as you mentioned, this asset class has a ton of value for business owners for a lot of reasons. One reason, as you talked about, is you use the term rich man's Roth IRA, just a way to put money away on a tax-free basis for your life. In the same way, there's a death benefit associated with it. That's part of the overall asset that can be valuable also in a lot of ways. From an estate planning perspective, which we'll talk about the impact of estate taxes for wealthier business owners, it can help replace a key employee or a key person who owns a company. We work with certain companies where, for example, I don't know, it's a local car dealership or a furniture store that's very associated with a particular name. Well, if that person dies, they might be able to pass on the business, but there's some value there that you'd want to protect, right? So there's death benefits used for a lot of different reasons. Business partners, a lot of our clients have 2 or 3 partners. Well, if one partner dies, do you want to be in business with their spouse? Probably not. So the idea of insurance at death is to buy them out. So there's all these reasons, but for whatever purpose they're going to be using this asset for, the key is these business owners want to leave their money in their business. They have cash flow needs. Their business earns a very high rate of return typically, or their real estate or whatever they're investing in. So we developed this terminology called retained capital, which allows you to retain the capital in your business, in your real estate, yet still buy the life insurance by borrowing the money from a third party at a very low interest rate. Today's world, 1.5%, 2%. And you get to invest that money that you otherwise would have to put in insurance. As long as you're doing better than 1.5%, 2%, you're much better off doing it that way. Down the road, Jonathan, on the other side, what I've seen is when you do go to exit, you're so glad that you did this sooner than later. Mm-hmm. One reason is, and this is, you get a $100 million offer for your business. You'd think that would be the champagne day of your life, right? But on the other hand, you cash out 60, 80, $100 million. What are you going to do with it, right? There's the easiest way to lose money is taxes and lawsuits, right? So if you don't plan for this in advance, life insurance is another tool in a lot of states, Jonathan, that's asset protected. If you own it in a proper estate plan, there's asset protection. So that's a big issue about why you would do this. There's a tax-free asset class. You just talked about how valuable that is. And you can do this in conjunction with other planning to mitigate these taxes. So if you're so focused on a business owner, I'm just going to get to 20 years from now, 10 years from now, my business is going to be worth $100 million, $200 million. That's my exit strategy. Even if you succeed, if you don't plan properly, it actually isn't going to go as well as you might think. So that's what we do, and that's where it fits into the world of a business owner.
Right. And then before we go into the specific examples, this is what I love about doing this strategy is, number one, if you qualify for it, which you have to have a net worth of about 5 million to do it. But if you qualify for it, you're already putting the asset out there and speed to the deal. You're getting the cash moving, and you already have an idea. Hey, I have something in the back of my mind where when I do exit my business eventually, I have something and you don't have to let it go to fruition where the cash value in the policy pays the bank off. You can pay the bank off early, and you could just supercharge the thing and take the income. Yeah. So that's what I love about it. We work with a lot of business owners who they're doing really, really well, but to tell them to go take $400,000 or $500,000, put it into this policy, it'll pay you $300,000 or $400,000 down the road. It sounds great, but that cash tie up is so big. And then what they end up doing is that now they're like, okay, well, instead of putting $400,000 or $500,000 into this policy, that's going to generate, $300,000, $400,000, $500,000 for me every year, tax free down the road. Let me finance it. I'm paying $13,000 in interest or whatever on $500,000. They might be paying 2%. And now the policy's making 8%. They're paying 2%. They're making 6% on the bank's money. And still they can go in and they can just continue to pay the interest only. They invest the difference back in their business. And instead of getting that 8% return, they're over here making, they could be making 25, 30%. In their business, making it even larger to increase the valuation to then be able to sell it and then pay the.
Yeah, I think Jonathan, a good way for everyone to kind of think of it in a very simple way. you wouldn't be a good business owner if you didn't believe that your business is going to grow at 10, 20, 30% a year, right? You have to believe in what you're doing. And there is nothing wrong with believing that your sort of plan for your financial future is the success of your business, the potential exit. But why wouldn't you hedge your bet? There's almost no reason you wouldn't, right? I don't care how much you believe. Everyone should. I mean, as you get older and more mature, you realize almost every decision in life is risk mitigation, right? And risk assessment. So the risk is, look, most businesses don't have an exit, to be fair. I mean, the percentages are there. So you can't rely solely on that as your future. You got to believe in it, and it can happen. We've seen it happen. So the idea is, yes, you build a nest egg to protect you. You build a nest egg with a death benefit, in this case, to protect your family. It doesn't impact your business as it's growing. And on the other side, if you are the one that gets to sell your business for $100+ million, it's a place to put your money for all these other benefits, right? So we are setting the plan up with something very flexible, lots of options, and to help along, assuming that you're going to be successful. This is not for people that are not successful. And I also want to reiterate what I said earlier. This is one part of the plan, and there's a lot that goes into it, right? So I have seen lots of cases where we've had exits. We've had exits where they sell to a third party, but I've also seen lots of exits where business partners, I've seen multiple 100 million plus. Now it's just the 50% of the one partner who bought out the other partner, $100 million plus buyouts of business partners, and they pay it off in an installment sale over 5 or 6 years out of profit. That's a big number. But you know what happens to the business owner that takes it over? They got a $200 million net worth now that if they died the next day would have almost $100 million tax due to the IRS. What's that going to do to the business, right? Don't you think the business partner that is taking $100 million, essentially loan from his other business partner getting bought out would want insurance on him in case he dies? How am I going to get my money? So what the point I'm trying to make is these tools are designed specifically for successful business owners, and wherever you're at on the spectrum, whether you're at the point of an exit or you're early in the process, these are things you have to be thinking about. One of many. And the sooner you do it to the point you're making, Jonathan, the better. And the biggest reason why people don't think about it is for what you said. I don't want to take money out of my business, but this is a way to kind of get the best of both worlds.
Yeah. And then two, if somebody is, and you're right, if somebody is not successful, this is not for them. This is for somebody who they feel confident in the fact that they can go and borrow this kind of money and they can make more on it within their business or whatever they're doing. So, okay. All right. Let's roll through a couple of these examples because I've really got 4 here. So we're going to talk about over time, kind of what you were saying there. Partner comes in, they're using the profit of the business, how it can be incorporated there. We got a family business model. So it's generally the same thing. And then a lump sum buyout. And the last this one's a little scary, exiting by death. But yeah, no, the last one is, it really does work for the last one too. But I think it covers every base.
Yeah.
And it does it so well. So
I think many buyouts are over time, unless you exit to private equity or you exit to potentially a competitor, but very likely in that case too, it would be probably over time. But very, very likely it's going to be over time no matter how you do it, right? Maybe you'll get the majority up front, but it's going to likely be over time. But most buyers, unless you get a very liquid firm like a private equity, which in today's world is actually popular, right? I mean, we actually are looking at that for part of our business. But unless you get someone who's very liquid, they're likely going to want to buy you out over time. And this is a great way to do 2 things. One is if you're the person selling, so let's say you're the partner who is going to stay in the business and you want to buy out your partner. One of the ways insurance plays into this is you can buy insurance on that partner as a cost recovery. So whatever you end up paying them, when they die, you receive that money back. So for example, if you're going to pay them $5 million for their portion of the business and you bought a $5 million insurance policy on them and they die even 20, 30 years from now, you're going to recoup that $5 million. So it's a cost recovery tool. So that's one way that it's used. If you're really forward thinking, Jonathan, and you say, look, we're both partners and I want to buy out my partner in 10 years or 15 years, I want to start planning for it now. You could use this policy more for this cash accumulation concept that you talked about and use that to pay them out over time. We've also seen as part of the exit, that the business agrees to buy one of these policies to protect the client down the road for either income or for estate taxes and things of that nature. As part of that, and I don't want to focus too much on this today, but a lot of our clients use pretty progressive and I'd say sophisticated tax mitigation tools when they sell a company. So if you're the one lucky person who can exit without being overtime, but $100 million in cash done today, I'm out of the business, you got to pay about 40% tax at least on that, right? Who knows what this new tax law is gonna shake out, but probably 40%. In California, probably 50, because I'm in California.
Yeah.
But even at 40%, if you cash out 100 million, 40 million is coming right off the top, right? There are tools that our clients use where they can sell the business inside of a trust that can defer that $40 million. And those are great tools for us to buy life insurance inside of, because now you're using the 40 million that the government was going to get to pay for all this tax-free insurance for yourself and for your kids and grandkids. So there's a lot of sophistication, like I mentioned earlier, inside of this. But I think a buyout, either from a family member, a business partner, potentially a third party, are probably the most common things that you see, quite frankly, because normally someone who's in your business or is related to your business is the first person you go to. They'll pay the highest price, and they're the most ready-made buyer in most cases.
Yep. Yep. And I love what you're saying about the trust. I mean, that's definitely a relevant thing, because what you can do, rather than using taxable dollars to fund the tax-free exit tool that you're going to use, if you can use dollars that are not going to be taxed, then you can get those assets off balance sheet into a trust, and then that funds this. Then you're talking a whole different ball game. But that, again, that is a story for a different time. But we can definitely help you.
One of those things where you just keep layering on new, when you have a good team, you layer in a lot of good ideas. There's not one solution. Having a lot of money is a good thing, but especially if it's in a business, it creates a lot of planning opportunities that have to be looked at. I think you mentioned the idea of sort of exit by death, right? That, quite frankly, is the most common, really, and the least planned for properly, I would say, and the one that has the most issues. Because death in the United States, when you own a business, is a event of tax. It's a taxable event when you die and pass it to your children.
Right.
And it's subject to something called estate taxes, which is very penal. And so anybody that's experienced this would tell you, if I have a $50 million business on paper, I can't just go down to, use that as a checking account. I got to sell the business. Well, the IRS, if they value your company at 50 million, they're going to want a $20 million check when you give it to your kids, even if your kids are in the business, which is what we see a lot. Well, how do you get the $20 million, right? You can't just write a check against your business, and it bankrupts a lot of business. Most businesses don't pass to the next generation, so it requires some planning, and life insurance becomes this perfect tool to provide the liquidity at that time. So I think for most people, if you have a successful business, they want, because look, money's one thing, Jonathan, but a lot of them, they look at it as their legacy, family farm, family business. I'd like to pass to, now again, that's not everybody, but I'd like to pass to the next generation. That actually requires probably more planning than anything, because it's an event of tax. Now, the other thing that a lot of people don't think about, I also wanted to point this out as another real important thing, is with most of the banks that you borrow money from as a business owner, if you read the documents, most of them, an event of default is death of the owner. I don't know if most of your listeners are aware of that. And read your documents, I would say 95% of the time that's true.
Yep.
Why? Because the bank says, hey, I loaned you the money because it's, Paul's furniture store or, Dick's Chevrolet dealership. But if Dick's gone or Paul's gone, how do I know what's going to happen with this business, right? So doesn't mean they won't continue to loan, but imagine now they come to your son, your daughter, your kids, your business partner, and they say, look, Dick just died, it's Dick Chevrolet, but don't worry, we're going to be okay. Keep our loans open. That may or may not happen. So having liquidity at the death of a key employee, an owner, for a lot of reasons is incredibly important. So those are, I think, a lot of the issues that your listeners that are going to really want to plan accordingly and plan to be successful. We've seen it on the other side of the spectrum when you're at the end. These are all things that the sooner you can start to look at and plan for will make a huge difference.
Yeah. And honestly, the question that I get most of the time whenever I show somebody this on paper is, why have I not seen this before? What, are more people doing this? And like it's because it's not really talked about. And that's the unique position that we're in. Because if you talk to any other advisor, they're going to say, hey, take the cash from your business and put it into a brokerage account. Like that's some sort of exit. And there's nothing wrong with that, but it's the same thing as just taking the cash and using it to put, to buy the $500,000 or $600,000 of life insurance. They're going to put the cash into a brokerage account, maybe up, it may be down, but you don't know what the stock market's going to do. And why would you worry about the market whenever you're worried about your business? The unique thing about the policy is it can't lose money due to market loss. So that's why the bank's willing to lend on it, because they know if you die, number one, they're paid off only for their loan amount. And then number two, or loan and interest due, and then number two, if the market crashes, the thing's not going to crash. It has no market risk. And then the third thing is, okay, well, if you go and talk to anyone else, they may say, well, Mr. Business owner, you should be buying real estate. You need to be buying apartment complexes with your money. And if they take their eye off of the ball and they go buy a 150 unit apartment complex, and then it's got terminal termite damage, now they're thinking about that. So it's really an asset that is completely unique from an accumulation standpoint. You're not worried about the stock market. The biggest thing you have to worry about, we're following LIBOR rates. And what are you borrowing at now?
Our clients are borrowing at 150 to 200. And, look, the time to start to create liquidity, Jonathan, is when you have it. I can tell you, I don't care if you're worth $300 million on paper. If it's not liquid and you're in a situation where you need to do it quickly, it's really, really difficult. And I can't overestimate enough that business owner who goes and buys real estate, even if it's a successful venture, when they pass it on, it's going to be a disaster. I remember to this day, I had a family I was working with in LA, and mom and dad were 96 years old, worth $350 million, Jonathan. And they lived in a house that was, even in California, was worth like $300,000. They never moved in like 75 years, right? They just lived the most simple lifestyle you can imagine. So we're sitting in the estate planning attorney's office. The estate planning attorney said, yeah, it's great. You have $350 million in real estate. It's generating about $14 million a year in revenue. But here's the problem. Good news is you qualify for an exemption that because most of your money's in a business, you can pay the tax over the next 15 years with interest. Here's the bad news. All that income has to go to the IRS for the next 15 years. You cannot sell or liquidate any property with having to take the entire proceeds and send it to the IRS as part of your payment. So essentially, you're running this business for the next 15 years for free. So what kind of $350 million gift is that, right? So that's not an isolated story. That's a real story. And so, again, we're planning on you being successful. But if you don't think about these things in advance, it's a nightmare. And at 96 years old, they had no choice. They couldn't even do this planning. They're too old. So you're literally leaving your children, they would have been best off just liquidating everything, giving the IRS what they could and walk away with 30-40 million off a $350 million, starting price, because, that actually would give them the best result. It's kind of a sad situation, but it's the reality. And so for our successful business owners, these are the kinds of issues that you need to think about. And a team like Jonathan and myself, that's what we do. We've seen the other side, so we're here to help you kind of work backwards. If you're going to get there, start planning now.
Yeah. Awesome, Michael. Well, thank you. You dropped some knowledge for the past 23 minutes. So I appreciate your time all the way out there in California. Man, you're looking good today. The light's coming in. So
thank you.
Cool, man. Thank you for your time. I appreciate you. If you have any questions about any of this, definitely reach out to us. Give us a call, shoot us an email. We can help you on that side. So thanks, Michael.
Appreciate it.
Thanks for watching this episode on Big Money Management on YouTube. Make sure to like, subscribe, do it all. We'd love to see you back here soon. See ya.
Thank you.